how the stock market works. Every second, millions of trades happen across the globe. Stocks are being bought and sold at lightning speed, fortunes made and lost in the blink of an eye. But have you ever stopped to think what's actually happening behind those growing numbers? What does it really mean to own a share of a company? How do prices move up and down? And who are the people and machines driving it all? Let's break it down. What is a stock? At its core, the stock market is about ownership. When you buy a share of a company, you are literally buying a small piece of that company, a teeny fraction of everything it owns and earns. That's why we call it equity. You are sharing in the company's future, the good, the bad, and everything in between. Companies sell shares to raise money, to build factories, create new products, hire people, or expand into new markets. And in return, investors like you and me hope those companies succeed. Because if they do, their profits rise and their stock prices usually follows. If the company grows, you win. If it struggles, your shares drop in value. It's simple, but it also the foundation of the entire financial world. The players in the market. Now, who is actually taking part in all this? Think of the stock market as an ecosystem full of different players with different goals. There are investors, individuals saving for the future, big institutions like pension fund and investment giants managing billions of dollars. Then you have got traders, people and algorithms who buy and sell constantly, trying to profit from even the smallest price moves. And finally, there are companies themselves selling shares to raise money. All these players connect through stock exchanges, the giant marketplaces where all the buying and selling happens. The exchanges where the action happens. Stock exchanges are where ownership changes hands. Back in the day, traders literally shouted bids across crowded trading floors. Now, almost everything happens digitally. Traders get executed in fraction of a second. Some of the biggest exchanges include the New York Stock Exchange, home to companies like Apple, Coca-Cola, and IBM. The NASDAQ, known for the tech powerhouses like Microsoft, Google, and Amazon, and major international like the London Stock Exchange, Tokyo, and Shanghai. Here is the something most beginners don't realize. When you buy a share, you are not buying it directly from the company. You are buying it from another investor who is selling theirs. The exchange job is to match your buy order with their sell order instantly and accurately. It sounds simple, but the technology and systems behind it are mind blowing complex. Supply, demand, and price. At the end of the day, every stock prices comes down to one thing: supply and demand. If more people want to buy a stock then sell it, the prices goes up. If more want to sell, the price goes down. But here is where it gets interesting. Behind every buy or sell is emotion, optimism, fear, greed, panic. A company report great profits, the price shoots up. A bad headline hits, panic selling begins. This constant push and pull between buyers and sellers, it is what gives the stock market its heartbeat, a rhythm that never stops. Market indexes, the pulse of the economy. With thousands of companies trading every day, how do we know if the overall market is doing well or poorly? That's where the market indexes come in. An index is just a collection of selected stocks that represent part of the market. For example, the Dow Jones Industrial Average tracks 30 major US companies. The S&P 500 follows 500 of the largest American corporations. It's basically a snapshot of the US economy. And the NASDAQ composite focuses heavily on the tech companies. When these indexes rise, it means on average, the value of those companies is going up. When they fall, confidence in the market is dropping. Indexes are like the market's thermometer, showing whether investors are feeling hot, cold, or somewhere in between. How investors make money? How do investors actually make money from all this? There are the two main ways: capital gain, when the stock price goes up and you sell it for more than you paid. Dividends, regular payment some companies share from their profit. Some investors chase quick profits, buying and selling often to catch short term moves. Others take the long view, holding for years, even decades, letting growth and dividends compound over time. And history shows that patience usually wins. Over the long run, markets like the S&P 500 have consistently grown, rewarding those who stay invested through the ups and downs. Brokers and technology. Once upon a time, buying stock means calling your broker and asking them to place a trade for you. Today, you can do it yourself from your phone in seconds. Online brokers and investing apps have completely changed the game, opening the market to anyone with an internet connection. But this convenience comes with a catch. Fast, easy access can tempt beginners to trade emotionally, chasing hype or panicking at dips. The best investors stay calm, do their research, and make decisions based on logic, not emotions. Market regulations and fairness. Now, for markets to actually work, people have to trust them. That's why regulation exists. In the US, the Security and Exchange Commission enforces rules that keep markets fair and transparent. They make sure companies tell the truth about their financials, prevent insider trading, and stop manipulation. Because without trust, there is no market. A living, breathing system. The stock market never really sleeps. When New York closes, Tokyo opens. When Tokyo wraps up, London start trading. Prices are constantly reacting, not just to company performance, but to world events, elections, wars, technology breakthroughs, even tweets. Every headline, every announcement, every rumor can move billions of dollars in minutes. And every participant, from a student investing $10 to a global fund managing billions, is part of this massive interconnected system. Wrapping it up, at first glance, the stock market looks chaotic, unpredictable, even random. But beneath that chaos is structure, a system built on trust, trade, and time. It's where companies meet investors, where ambition meets opportunity, and where every risk carries the potential for reward. The market reflects us, our hopes, our fears, and our endless search for growth. And in the next chapter, we will dive deeper into what really drives it, the psychology of markets, why we panic, why we get greedy, and how human behavior shapes every boom and bust.